Hey everyone, thank you for joining us today. We're going to get started in just a couple of minutes. We're going to allow a few more people to hop on. If you have any questions, please use the question feature on the right-hand side of your webpage. Thank you. All right, good afternoon, everyone. Thank you for hopping on today's presentation. If you have any questions throughout the presentation, please use the question option on the right-hand side, and we will be answering logistical questions throughout the presentation, and then all technical questions we will hold till the end. Thank you.
Thank you so much, Allison. Thank you for joining us today. Today, we're going to be covering some questions and issues regarding the global business disruption from COVID-19, specifically focusing on having cash abroad and how that might impact your transfer pricing and how you can deal with the foreign exchange part of that. Joining us today, we have Mark Chandler, who is the Chief Market Strategist for Bannockburn Global Foreign Exchange. We also have Joe Aretti, who is a Senior Managing Director with Bannockburn. And from Withum Smith & Brown, we have Marina Gentili, who is our Transfer Pricing Lead, and I'm Kimberly Phelan. I run the International Services Group at Withum Smith & Brown. We're going to start with Mark to give us kind of an update on what's happening around the world with markets and what we can look forward to. Mark, go ahead.
Sure. Well, thank you, Kimberly. Thank you for everybody for joining us today. I really have an awkward position to tell you because I really have a lot of bad news, of course. As you know, with the big disruption to businesses is coming from the reaction to the pandemic, where the major economies have shut down. And what we're trying to do is put a number. We know that Q1, the first quarter, was bad. Well, here we are in the middle of the second quarter. How bad is the second quarter going to be? So what we do is the several Federal Reserve banks have their own real-time estimate of GDP, and it's sort of GDP now, GDP trackers, and the three regional Feds that are looking at it. Atlanta Fed thinks the economy is going to contract at an annualized rate of almost 43% this quarter. Annualized rates. New York Fed said it's going to be closer to 31%. And the St. Louis Fed is the most bearish of them all, contraction of about 48%. And so this just gives you a magnitude that, again, these are annualized numbers. It just gives you a magnitude, a sense of the magnitude of how bad the economy is going to be hit when everybody stays at home, or when most of us get to stay at home or have to stay at home. Unlike previous crises, what makes this one stand out is that the other crises that we've experienced, like the great financial crisis, like the tech bubble, like the savings and loan crisis, these were financial crises that spilled over and hit the real economy. This time, it's the real economy that's causing financial strains. And the central banks and governments have reacted very aggressively to this economic shock. And when I say aggressively, here's what it looks like right now. Because there's a bill in Congress now that's being debated about, another one, but excluding that, up to now, what's been agreed upon, the Congressional Budget Office says is worth about an 18% budget deficit. That is, the government, the US government, is going to be spending about 18% more than it takes in revenue. 18% budget deficit. This is just huge, bigger than anything we've experienced in our lives, probably the biggest since World War II. And this is before the next spending bill is approved. And the US is by far spending more money than other countries as a percentage of GDP. If we're spending 18% deficit, most other countries are looking at something less than half of that. And it's not just the federal governments that are responding, but it's also the central bank. And the central bank's tool, now that interest rates are at zero for most of the world, what the Federal Reserve and other central banks are doing is expanding their balance sheets by like buying treasuries or mortgage-backed securities or corporate bonds, various financial assets. The Federal Reserve's balance sheet has gone up by almost 50% since the middle of March. So we were at about 4.1 trillion, and now we're just less than $7 trillion. That's the size of the Federal Reserve's balance sheet. Looking at the European Central Bank, its balance sheet's grown as well, but only by about 20–25%. The Bank of Japan, as you know, Japan is the third largest economy in the world. And the Japanese balance sheet was already bigger than the US. That is, the Bank of Japan's balance sheet was 100% of GDP before the crisis. So they've only increased it a little bit, talking about 7%. So again, you can see how the US federal government and the central bank has had a very aggressive response earlier and larger than most other countries. Partly it has to do with the role of the dollar in the world economy. And I know many people have still not gotten the unemployment benefits and are concerned about these things that are very so important to us right now. And this is the shocker, I think, is since the middle of March, something like 30 million Americans have filed for unemployment benefits for the first time. 30 million Americans, that's almost 20% of our workforce. And of course, a problem of that magnitude, there's always going to be some problems in the distribution of the unemployment benefits and systems being overwhelmed. And that's primarily the difficulty right now, is getting these programs off and getting the money distributed. But there's also other kinds of dislocations. And one way we think about the dislocations in the capital markets is really a function of volatility. Volatility is risk. I'll give you an example. The volatility of the stock market, we call it the VIX. The VIX jumped from about 10 to 15%. It jumped to 85%. Now, volatility in the stock market hasn't gone back to where it was before, but it's lessened. We're at about 30% now, which is only twice what it was before the crisis. And the same thing is evident in the currency markets. The euro dollar is the most traded exchange rate. The 3-month volatility, sort of a standard benchmark measure, it jumped to 14% from about 4% before the crisis hit. And now, like we saw with the VIX, it hasn't gone back to normal, but it's lessened a bit. We're now at about 6.5%. It's about 50% higher, in effect, than it was before the crisis. The other part of this, of course, if you shut down the economies, you have disruptions in the capital markets. Another consequence of that is going to be disruption in trade. So first, because economies have shut down, there's going to be less importing, less exporting. There's also dramatic disruption in transportation itself and disrupting supply chains. And more broadly, the rise of economic nationalism even before the crisis. And the efforts to have import substitution strategies, or more likely now, reshoring, bringing back some things that we had outsourced, like medical supplies, medical products. In the US and Europe, we import something on the magnitude of like 90–95% of our antibiotics. And as you've seen through this crisis, we import a lot of medical devices and supplies. This is going to change, not just for the United States, for Europe, for Japan, for many other large countries, they will want to reshore and become self-sufficient in medicine and medical supplies. It's also causing a problem with supply chains themselves. And I think that what happens is that supply chains are very long, complicated, and far away. And I think the opposite is going to take place now, where more countries or more companies are under pressure to simplify their supply chains, bring them closer to home. It might not be onshoring in the US per se, but maybe it's bringing it to Mexico or Canada or Colombia, or in Europe, bringing it closer to Eastern Central Europe from the Far East. So I leave you with the idea that the economies have taken a big hit. Countries have, central banks and federal governments have responded aggressively. It doesn't avoid the crisis, but the good news I have for you is that we're probably going through the worst of it now. That is, may probably be where the major economies bottom out. And with that, maybe I just turn it over to Marina and to give us some insight into what this means for transfer pricing.
Great. Thanks, Mark. Go ahead, Marina.
Yeah, thanks so much, Mark. That was fascinating, and you know, don't shoot the messenger, I guess is the theme there, right? I don't think anyone's in shock, but yeah. So anyhow, lots going on with transfer pricing due to COVID-19 disruptions. Want to give you some insight there, both in terms of transfer pricing compliance for fiscal year 2020. And also the opportunities that this is presenting, because there are a lot of them, and they play right into a lot of what Mark was talking about in terms of supply chain disruptions and nationalistic approaches. So definitely want to hit on that as well. First, I want to give you just a little primer. I'm aware that probably not everyone on the call is completely fluent in what transfer pricing is, but just the short of it is it's the internal pricing between multinationals. So any company that operates in more than one tax jurisdiction, crosses an international border, there's a lot of room for tax manipulation in that internal pricing, that intercompany pricing. So tax authorities are on top of it. They're asking for arm's length pricing or market pricing. So essentially, they expect you to operate with your global affiliated companies as if you were total strangers and didn't even know each other. What would what deal would you make for and this is the transfer of goods, services, royalties if you're licensing some kind of intellectual property, or financing, loans, cash pooling, guarantees, etc. So, the definitely the world pandemic is not normal course of business and has nothing to do with transfer pricing or tax rate arbitrage. But it's on the taxpayer to present that case, right? Because the tax authorities, I think are going to be on the quiet side around it. There's been a few stirrings, but they've all along the lines of the taxpayer needs to step up and present any kind of adjustment, if they're falling outside of their normal range of profitability and sort of triggering issues around their transfer pricing mechanisms. So, and it makes sense, you know your business best, so that's the critical thing to do. So, quantify and adjust is the theme of, transfer pricing compliance and COVID-19, and I just can't say it enough. I mean, that's really what it is. You need to get to the point where you're telling the story of your business in terms of the operational aspects of this crisis or any other for that matter, and going forward in that direction. So also good time to revisit strategies and consider opportunities to address. So let's go to the next slide. We can talk about specifically for FY 2020. So transfer pricing is an annual event. At the time of your tax return filing, you're meant to have your transfer pricing analyzed, have your study, present that it's arm's length, and this is US and other tax authorities. I mean, there are a lot of differences in different countries, but a lot of them comply with OECD guidelines around transfer pricing. So as you're doing this, and a lot of these documents, they're penalty protections because the penalties are very steep around getting your transfer pricing wrong, let's say, or the tax authority considering that it's not arm's length or market pricing. So as you're going through 2020 now, which will then be documented, about a year from now as you're filing your return, you need to consider what's happening with your business and what's unique to your business. So, is your supply chain being disrupted? I think we can answer yes for many, many people right now. Are your sales reduced? Lack of customer, lack of inventory, et cetera. Do you have increased expenses that you're not going to earn revenue from? For example, I have some clients, it's unique to the industry, but I have some clients who now is the season for their product, whatever that product is. And they're, out there really heavily investing in promotions and advertisements and TV ads, et cetera. And they've unveiled the new sexy model of their whatever. And now no one's going to buy it because it's sort of a 3-month sales cycle throughout the course of the year. And these 3 months are really weird, right? And disruptive. So how is that going to work? So with that client, I would sit and again, quantify this, this activity. And we could show that if not for these COVID disruptions, this company would have had operating margins, similar to last year, kind of this normal course of business. So maybe we take a 5-year approach or a 3-year approach, or look back to 2008 and look at what happened, in the market, and then be able to quantify that adjustment, that difference, and adjust for it. I would, kind of back out of that impact and get them into their transfer pricing range. And then there's also the other one-off non-recurring expenses like severance and other factors that'll come into play this year that don't happen every year. So again, has nothing to do with tax manipulation, has nothing to do with transfer pricing, and it should be, excluded from the mechanism and made clear in that direction. And then reconsider the evolving FAR. So transfer pricing analysis is all about the functions, assets, and risks of one affiliated company relative to the others in the global business. So now, there are some changes, there are some shifts happening. Are we changing the supply chain? Are we sourcing elsewhere? A lot of times companies are set up where, there's one entity that's sort of the entrepreneurial risk taker of the global business. They're the entity that owns and develops the intellectual property, whatever that is, if it's a technology, if it's a name brand, whatever it is, the secret sauce of your business, right? So you typically think of it as almost a hub and spoke system. That's the center. And then everyone else is some sort of service provider to this business. So a lower risk entity, a lower function entity. But, this is a time where we really see that, low risk does not mean no risk. So we need to sort of relax that transfer pricing model and say, hey, that entity can't absorb all of the deficit, all of the loss related to this disruption. It's got to branch out to the other, affiliates as well. So that's on the compliance side. If we go to the next slide, we can talk about just revisiting global transfer pricing strategies. There's a lot of value add right now. I mean, there always has been, honestly. People think of it from the compliance side, but there's a lot of value add to the operations, and I work with my clients regularly related to tax minimization strategies. Certainly, transfer pricing is a huge tool for that, but really, honestly, cash flow management strategies. And I think one of the big things right now is, if not the biggest thing, cash is king, right? CEOs, CFOs are trying to access it as much as possible, and internally, going through their global organization to figure out, where it is, how do I get to it as quickly as possible and reallocate it to the other affiliates who need it. Well, not everyone has a very sophisticated cash flow management strategy. And this is coming to light in this day and age where, there's realization that cash is getting trapped in countries like India or China, where it's just historically very challenging to repatriate funds out of those markets. So sometimes it's a 3-month lag and you have to, come up with all this paperwork and, other aspects to it. So having, a cash flow management strategy where you know ahead of time where it's going to be in one location or two locations or whatever works best operationally for your business, allows that that access to it quickly. So that's a key there. Opportunities around, Mark was saying in terms of import export, a lot of changes happening there. I think, importers are going to be more strategic about their customs declarations and minimizing customs duties. And there's a lot that can be done there to make sure that, your business has the right strategy for dealing with this. For example, there's the, option, the flexible program where you leave your customs declaration open and you have, a certain amount of time to finalize it. That allows you to see what happens, throughout your year and possibly adjust pricing as needed along the way. Repatriation of funds, that's certainly a big part of it. Kimberly on the international tax side, I know works with clients a lot to handle that aspect of it.
And that's all changed since 2017. So
right, goes hand in hand with transfer pricing. So we work often together in that arena as well. The transfer of intellectual property. So it's a good time to value your IP, whatever it is, the tech, the brand names, whatever your secret sauce is. It's a good time to value it and to offshore it. So while historically, with high tax rates in the US, the consideration was, hey, maybe locate this IP in a different tax jurisdiction with a lower tax rate. Typically that's the entity of your organization that would earn the highest return going forward, does have the highest risk, in the overall business, et cetera. With the new tax laws, it really hasn't been that advice because, more favorable tax rate in the US, people keeping their IP locally. At this point, it's about the valuation of it, that one-off original, event where you're valuing the IP and selling it to one entity or another. Just, interest rates are down, projections are down. So in general, that value is just going to be lower overall. So it might be a chance to look at that. And also now legal agreements. So what's the new normal and are they reflected in your legal agreements? So it's time to look at that, that as well. So.
Exactly. It's time to just analyze everything, especially when you're dealing internationally, trying to bring the cash back, trying to reduce your worldwide tax rate, and making sure that your transfer pricing is on track and reflects the current business environment, so you avoid penalties down the road. So part of managing your worldwide business is managing the exposure you might have to foreign currencies. So Joe is here to tell us about his strategies and what he's seeing in managing foreign exchange in this environment. Joe.
Thanks, Kimberly. Good afternoon, everyone. Appreciate the time today. I first want to thank my esteemed colleague, Mark Chandler, for distributing the memo to me that it was a suit and tie webinar. Appreciate that, Mark. In all seriousness, again, thanks for the time. I've got a few slides to go through, and I want to, in the interest of time, obviously stay on schedule, and I might go through them a little bit more quickly than I would normally like to make sure we have time for questions and such. But I would say that if you review the slides afterwards and want to come back with some individualized calls or chats, I'm more than happy to spend the time on that. Just a quick comment on Bannockburn Global Forex, who we are. Basically, we're a bank-owned boutique foreign exchange firm. So anything that your company might do with your bank from a foreign exchange standpoint, spot trades, hedging transactions, advisory and such, you can do that with us. We've been around for about 11 years. We'd like to think that we're FX experts, so to speak. I'm the ultimate one-trick pony. I've been doing foreign exchange my entire career. It's the only thing I know. And we've got 27 people at our firm that are just like me. We're a partner to your treasury function. So again, anything you do from a movement of money, movement of cash around the globe, mitigating the risk associated with currency exposures, that's what we specialize in. Next slide, please. Thank you. You know, a lot of times we have a discussion with companies, and it's interesting. They'll say, "Well, I don't really have any FX risk. You know, we do business internationally, but you know, but I only transact in dollars." You know, there is FX risk, even if you're only transacting in dollars. Now is a good example of that. If you're exporting to virtually anywhere, the dollar is, you know, absent the last 2 business days, the dollar is abnormally strong. So as you sell your product globally, your product has become more expensive just because the buying power of those foreign currencies has gone down. So there is exposure there, even if you're dealing only in dollars. Obviously, if you're importing or exporting in local currency, there's direct foreign exchange risk there. If you're a multinational, if you have either a manufacturing plant or a subsidiary outside the US, if you're a US based company, there's risk there from a balance sheet perspective. And then if your company is involved in any sort of potential bolt-on or acquisition to a foreign company, you have FX risk as it relates to purchasing that particular asset. Next slide, please. Thank you. All right, so this slide, if you can look at it, the numbers aren't as critical as the increase in the numbers. So what we're looking at here, and Mark alluded to this earlier, is how volatilities have exploded so far this year. I did this same webinar last week, and the volatilities were higher then. But of course, the purpose here is not to incite fear, but rather present facts. And currencies have come back down from a volatility perspective a little bit. The currencies exactly don't line up there because they're stack ranked, but you can see, for example, at the start of the year, the British pound, for example, was around a 9% volatility. It has come back down to 9%. It was up around 14 to 15% last week. So you can see that things have somewhat stabilized. But what I would say, and when we typically speak with clients about volatility, and this was a recurring theme for the last probably 3 or 4 years until the pandemic, what we would hear from companies is, well, you know, the market's not that volatile. Currencies don't move that much, so we're not concerned with it. And my answer back to that every single time is, well, the market isn't volatile until it's volatile. And then it's too late sometimes to do anything about it. And so we often preach the idea that it makes sense to sort of preemptively have a strategy around risk management before the market goes haywire. Next slide, please. Volatility is one measure of sort of the impact that this pandemic has had on currency markets. Exactly how much currencies have moved one directionally is typically more critical to companies. You can see that so far this year, really the 2 primary currencies that have had, well, I guess 3 primary currencies that have had a strong an increase in value, if you will, against the dollar have been the Japanese yen, Taiwan dollar, and Hong Kong dollar. Most currencies are significantly weaker against the US dollar, which is what I alluded to earlier. You can see, for example, the Brazilian real, South African rand, Mexican peso, those are what I would consider emerging market currencies. The South African rand is closely tied to oil and other natural resources. You've seen commodities decrease in value. So you can see why those currencies have moved lower. And really what that does is it presents opportunities to potentially lock into favorable import costs from a hedging perspective, if in fact you happen to be manufacturing or importing from those countries. Next slide, please. Yeah, thank you. Okay, so I did want to go through a couple case studies just in terms of how hedging works. Forward contracts are the most basic and popular form of hedging currency risk, and really a forward contract is just an agreement between you and a counterparty, whether it's Bannockburn or your bank or whomever, to purchase or sell a currency against another at a particular rate at a particular date in the future. So the most common sort of thing that comes to mind when I think about forward contracts is if a company purchases a piece of equipment from Europe and there's progress payments on that, maybe 10% up front, 40% when it ships, 30% at receipt, and maybe a 20% retainer. And those payments are due over time, they're due in euros. And so you can lock into a contract today with your FX provider to fix the US equivalent cost of the euros that you might be purchasing. The key benefit to forwards is it eliminates exposure to fluctuation in currency values. So whether that currency gets stronger or weaker, you're completely insulated from that movement. It fixes your costs, it eliminates an independent variable that you otherwise have no control over. And there's no out-of-pocket premium associated with a forward. So it doesn't cost anything per se. You're eventually going to need to buy those euros anyway, and there's going to be a cost to purchase a foreign currency. So there's no extra cost to doing a forward per se. Obviously, the certainty of your exposure is a prerequisite when you want to consider hedging with forwards, because they do create obligation between you and a provider. And so if there's any risk or chance that you may not want to buy that equipment, then you probably wouldn't want to hedge via forward contracts. Okay, next slide, please. This is a case study. This is not the purchase of a piece of equipment, but rather this is a company that is selling into Australia, for example, and they're selling in local currency, so in Australian dollars, and their functional currency is US dollars. The current situation in the market, the Aussie dollar depreciated pretty rapidly against the US dollar at the beginning of the pandemic. It has sizably recovered in recent months, and so the company is now considering locking into the current exchange rate because they're uncomfortable with this volatility. I think the concept to focus on here, and these are kind of real market rates, is that in a spot rate environment of 0.656, the company can lock into a strip of forwards. And in this particular case, in the example that I'm doing here, it's not uniform amounts. You can see that the exposures sort of fluctuate over time. It's a non-cyclical business. In this particular case, the company can lock into an exchange rate that is pretty close to the current spot rate. So when I mentioned there's no cost per se, you can kind of see evidence of that here. And then when these hedges mature, the company can either deliver the $4 million Australian dollars to their counterparty and receive the equivalent US dollars, or they can net settle the contract at maturity and just recognize the gain or the loss depending on which way the exchange rate moved. The next slide is another example. In this case, this company is setting up or has a manufacturing facility in Mexico, and they have payroll and other operating expenses denominated in Mexican pesos. The market situation here is that at the start of the pandemic, the dollar bought about 19 pesos. It now is buying about 23 plus pesos. It got as high as above 25. It has come back down a little bit, but the situation remains pretty volatile. And so this company is saying to themselves, well, you know, I was buying and getting 19 pesos to the dollar. I can get over 23 now. That's a 20% improvement in margin costs and input costs. I'm going to lock into some forwards. So this client can buy a strip of Mexican peso forwards. Again, there's no cost here. In fact, the exchange rate over the strip, the average rate of 24.0943, is better than the current spot rate. So you can lock into forward rates at better than current market. And the reason for that is interest rate differentials between the two currencies being exchanged. So it's a pretty attractive scenario. That's the example where, hey, this currency has significantly devalued. Let's take advantage of that and lock into a strip of forwards. The third case study, and this gets a little mathematical. And again, I would say if you're a company that's considering buying another company outside of the US, this is the scenario that you might be presented with from a hedging standpoint. The concept here is if you're looking at, for example, an asset in Canada that's going to cost 75 million Canadian dollars, and you're not sure if the deal is going to close or not, you can purchase a Canadian dollar call option. There is a cost to do this, but what you're doing is you're eliminating some volatility. So if you look at the current spot rate in the Canadian dollar, it's around, well, yesterday it was around 1.3875. If we look at historical volatilities, not implied, but historical volatility, that's still above 13%. So the value at risk, using that math on $75 million, is over $7 million US. So in other words, this deal might cost you $7 million more in 60 days if you don't do anything to protect in case the Canadian dollar strengthens in value. So what you do is you purchase a Canadian dollar call. The cost of that call, in this case, the company chooses a strike price of 1.36. So they're okay with a little bit of dollar deterioration. And the cost of that call option would only be $210,000. So the concept is I'm going to spend 200 grand in order to prevent the possible loss of $7 million. And I get full upside potential. The benefit of the option is that it doesn't create any obligation between you and your counterparty. You hold the cards. You have the right to purchase those 75 million Canadian or not, depending on if your deal closes. Thanks. The next slide is a little bit of a commercial, I guess, for Bannockburn. We can do a thing called what we generally call a back check on exchange rates that you've been given by your current provider, and we can basically ascertain what it's costing you to execute those transactions. And oftentimes we can be a little bit more competitive. So I didn't want to spend too much time here, but just know that if you're interested in sort of a fact check or a sanity check on how the pricing is that you're currently receiving, we can do that for you. I've always been told that giving a commercial on who your company is at the very beginning of a slideshow is the worst thing to do, so I put this at the end. I'm not going to spend any time on it, but this is who we are and a little bit of facts about Bannockburn. So if you have any questions on this, you can always, like I said, shoot me a note or give me a call. The next slide is just a sampling of who some of our clients are, and I think that concludes my presentation.
Great. Thank you very much, Joe. We have quite a bit of time now that we can talk about some questions and answers. So please feel free to send in your question via the chat box at the bottom right-hand side. I want to start, though, going back to what you were talking about, Mark, and how we're increasing all of this government spending, and then the central banks are purchasing all of these assets. So I have two questions. Will that fuel inflation? And as I was listening to you, this took me back to, I think, the mid-'80s. With the potential for inflation and the potential for recession, are we looking at stagflation?
That's a good question. I think this was a lot of people's minds. I mean, how can we have central banks printing a lot of money and government spending a lot of money without it causing inflation? And I think that in some ways we live in a different world now. I think that, for most of our lives, most of our careers, the politicians or central bankers, they just could sneeze and it would seem to cause inflation. And now the biggest problem that policymakers had in the US, Europe, and Japan before the crisis was inflation was too low. So stagflation, that concept refers to both too weak of an economy, it needs stimulus, but inflation is too high to get monetary stimulus. And I think that would be like sort of a dark scenario of what's possible. Yeah. I think what a lot of people are concerned about I think a lot of people like myself think that, yeah, it might take a while, but the economy is probably bottoming and it take a while to recoup those levels that we had before. But that's the direction we're going to be going. It might be gradual, it might be haltingly, but we're going to get better growth. And I think the bigger problem people have is what's going to happen on inflation. And I think there's two big camps. One is this monetarist camp that thinks that inflation is caused by printing of money. And there's a lot of printing of money, so it's going to boost inflation. Another, for me, a more sort of subtle form of inflation could come from what we were talking about with trade. The IMF estimates that a good chunk of what kept inflation down in the 90s and in the past decade has been the supply chains, which is allowing businesses to move production to the lowest cost, whether it's labor costs, closer to supplies, less transportation, the whole ecosystem that might be necessary to make an iPhone, for example. And so they are concerned that the unwinding of globalization, the reshoring of medical supplies, is that going to boost the cost of medicine and products, or is it going to lower them? And I think most of us accept the idea that it's probably going to raise them. But I think also when you're thinking about inflation, just remember how economists think about inflation. It's really a general increase in price levels. If you have an increase in beef prices, that might not be inflationary because people might substitute chicken for beef or become vegetarians, right? Substitute for a lower price good from a higher price. So what economists mean by inflation is a general increase in price levels. And right now, at least in the near term, the bigger problem is deflation. That is, prices are falling. And it's really a question of how fast they fall. Just this morning, our northern neighbors, Canada, reported that inflation on a year-over-year basis was negative. Think about what happened in April when oil prices fell into negative territory. They begin the year, say $45, $50 a barrel. They fall below zero. And today we're at $30 a barrel, $32 a barrel. So headline inflation stays depressed. So I think that our biggest concern is probably not going to be inflation in the near term. So the near term, give me this year and next year. Then it might be a different story as the economies rev up, and with all this debt being taken on, what do debtors want? We want a little bit of inflation, not ruinous inflation, but just a little bit of inflation so we can pay back cheaper than we borrowed. So I think our biggest problems right now probably is not inflation, but it's getting these 30 million, 33 million Americans filed unemployment benefits back into the workforce, get the economy going again. And then I'd say that inflation is probably going to be able to take care of itself.
Great. We can all sleep a little bit easier not thinking about stagflation. I'm going to turn to a question that we received from the chat box. And Maureen, I believe this is for you. The question is, how can you adjust your transfer price to take advantage of the economic instability when you have to have a transfer pricing study that is based and that it's based on, or do you simply adjust the numbers? So their example was, our Indian affiliate has to have a local transfer pricing study every year, and the Indian government has challenged it to make us drive it up by a cost plus an extra 4% last year. So how can they drive that cost plus number back down to a normal number?
Okay, it's a really good question. I feel like I need to add one of those disclaimers of I'm going to give general advice, but consult with your doctor type thing. So please, whoever asked that question, just reach out to me, because I need to know some more specifics about your business to, fully answer it. The devil is very much in the details, but in general, overall, when you have a transfer pricing study, it's not, the adjustments I'm speaking of aren't meant to be only, in the accounting or anything like that. It's reflected in the transfer pricing study for that year on both sides. So you would reflect it, I assume it's India-US transaction, you'd reflect it in both transfer pricing studies or your combined, US-India transfer pricing study. And it would look something along the lines of, here's your normal operating margin. In transfer pricing, we typically do a 3-year average, okay, depending on the industry. So if we reflect a 3-year average operating margin for your business, typically of, 5%, but now, taking in all of your expenses, it's, puts you at 2%, let's say, or in a loss position, and you're bumping out of that range of comparable firms, we would simply take those extraordinary items like the severance costs or the unusual disruptions expenses and mathematically remove them from your financials. So the tested party financials, I would show the normal, then the post adjustment, and compare it to the comparable firms and show that, if not for this one situation, you would be in this range of comparable firms. And I would do that in whatever way is specific to your business. Some industries, the 3-year average isn't going to capture, what's happening. Maybe we have to extend to a 5-year average or, take a different approach. And there are so many. I mean, transfer pricing is a very, I got my
art and a science.
Yeah, an art as well as a science, exactly. I have my bag of magic tricks. I know what the wrong answers are. I would not give you the wrong answers, but whatever I can justify and defend from a commercial economic standpoint is what I would do, for your business. But specific to India, we're seeing a little bit of flexibility, believe it or not, on the part of the Indian government, or potential for flexibility around, understanding that, possibly they're taken some extreme positions about the higher net cost plus markups in that market due to the low, their justification is we have such low labor costs that our markup should be higher. And, we might be able to, slightly get away from that at this point. So that's the general answer to the question.
Great. Joe, I have another question that's come in for you, which is someone says, my board is generally hedge averse because they think that only the banks win. That's how they view the hedging transactions. So how does that concept work? And how do you train a board? How do you get around that concept that this is something where only the banks win? I know you've given us some great examples in the case studies, but can you address that? How do you address a board and get them around that conception?
Yeah, sure. We hear that a lot, as a matter of fact, and a lot of times companies will say, we did a hedge one time and it didn't work out, and we lost a lot of money, and I can only suppose that the idea there is that they locked into a hedge, whether it was an interest rate hedge or a currency hedge or some kind of a hedge that eventually had a large mark-to-market negative position. In other words, gosh, golly darn, if we hadn't done this hedge, we would have made so much more money. My response to that typically is, the purpose of the hedge, and we try to stress this with clients going in, the purpose of the hedge is of course not to make or lose money. It's simply to fix costs, to provide a forecastability, to lock in margins, to give you rate certainty. If you're going into it thinking that you want to try to win, you're probably not taking the right approach. And I've often talked about the psychology of hedging with clients to try to get them over that hurdle. A question that I always ask is, what's worse? You don't hedge and costs go up, or you do hedge and you could have done better had you not hedged? And typically the answer is, well, it's worse if we don't do anything and our costs go up. So, opportunity cost is okay. The other concept there is that if you hedge a percentage of your exposure and the rate moves in such a way that your hedges are underwater, that by definition means that whatever exposure you've not hedged is now in a better cost position. So anyway, those are kind of some thought process that we try to drive home. Reasonable minds can differ in terms of how hedging is viewed. But I did emphasize that there is no cost per se to execute forwards. And so, the banks winning per se doesn't necessarily, make sense to me. And of course, we always try to make sure that we talk about those concepts in a way that doesn't offend anyone. And, at the end of the day, it's every company's decision what they want to do. We just try to present all the facts for them to make a good decision.
Maybe I could just jump on top of that to reiterate something, and that is, I think that especially in light of, Kimberly, of what you do with the international like insurance part, that currency hedging is a way to insure yourself from a risk. You might sell business disruption insurance, fire insurance, flood insurance. This what Joe I think is talking about really is a way to have currency insurance. And we just call those insurance products the forward or the option that those examples that Joe gave. But this is primarily an insurance product. And even though it's supposed to rain here where I am now, I am not going to cancel my fire insurance because it's going to rain. And I know that's going to be I pray that my fire insurance is a loss leader for me. That's going to be a wasted capital, but it lets me sleep at night and reduces the volatility, if you will, of the household balance sheet.
Excellent. Joe, is there a certain level of transactions that you need to have a volume before where you should really consider hedging, or is there, if it's just small, should you let it ride? Where do you find that balance?
Yeah, that is a good question. I mean, I think every company probably has a threshold at some point. The word that always comes to mind for me is materiality, rather than a dollar amount. Like, how material is the risk that you have? And it's typically a pretty, I don't want to say simple calculation, but it's a calculation to be done. If a currency moves, 5%, what does that do to your gross profit margin? And so to try to consider that, I think that's an important thing. There's no minimums per se that the market needs in order to have a hedgeable amount. I will say that if the numbers are acutely small, a lot of times the pricing isn't as good. So in other words, the exchange rate that you can get on a $20,000 hedge is probably not as market competitive as on $1 million hedge, for example. But at the end of the day, materiality is kind of the word that I always think of. And the other thing too is, I'll have a conversation with a prospective client and they'll say, well, don't worry about it. What we do isn't big enough. And my answer to that is always, well, try me. Let me know what the amount is. And I'm not going to waste my time. I'm not going to waste your time if it's an amount that doesn't really make sense. But let's have a 5-minute conversation just to see if it might.
Okay, great. So always think about it, and there is that opportunity. Marina, coming back to you, you said obviously transfer pricing errors or misplacement of the rate could end up with big penalties. And I know every country is going to be looking for additional tax revenue as they've all spent money on all of these stimulus packages. So what will compliance look like in the future? And how do you adjust to this? Do you expect to see, I'm going to get back to this, but do you expect to see a lot more focus by many jurisdictions on the compliance piece? And how do you handle that?
Yeah, I do. I mean, first of all, transfer pricing, and I'm going to date myself here, but I've been at this since, the mid 90s. And there were 9 countries that had transfer pricing regulations at that time. Now there's, every country, in the world, has transfer pricing in one way or another, or gives nod in their legislation to the OECD guidelines. So, everyone is just trying to protect their tax base, right? And so it's always been a hot topic, or it's increasingly a hot topic, let's put it that way. But now, certainly with these disruptions, I mean, I think we're going to see all tax authorities, like everybody else, just trying to, earn revenue, right? Trying to kind of restabilize their business. And I think there are going to be a lot more, audits at some point, and I think transfer pricing will be a big part of that. It's kind of low-hanging fruit, especially honestly at the middle market. People sometimes think we're not big enough, but the truth is, it's less risky at this level, right? It's more of a sure thing. You're less likely to litigate like giant multinationals that have more funds to hire advisors and go to tax court, et cetera. So it's a little bit easier to get funds there. By the same token, if you're in the middle of an audit, transfer pricing audit, it's a great time to settle, right? I mean, the IRS is going to be in other countries will be more likely to have a conversation and settle with you. And then Kimberly, let me just add, I know this wasn't your question, but on the APA or Advanced Pricing Agreement front, that is the one area, and this is for people who don't know, where you take this bilateral or multilateral approach and you get a competent authority ruling from the tax authorities. So you have this sort of prospective way to say, hey, let's set our transfer pricing 5 years forward and maybe roll back the open audit years, and this is good for giant multinationals, for companies that are in contentious audit situations, right? So you have this certainty around your transfer pricing. Well, guess what? That certainty relies on facts and circumstances at the time of the negotiation. And there's this little bit of a panic of all bets are off now in this, COVID disrupted environment, right? But the IRS, the APMA, the APA office has issued a little guidance on this and early, which I was really happy to see. And they're basically saying, hey, it doesn't mean all bets are off, just taxpayers should present to us what the proposal is, what the adjustment is, what the impact is, and then we'll discuss from there. And they did specifically say, look to 2008, look to other years where there have been some disruptions, and try to, take some guidance from there as to how these things were settled.
Great, thanks. So we are in a very much changed global environment. So I'm going to start with Mark, but I think you could all chime in on this. Mark, do you see the Chinese yuan replacing the US dollar as the currency of global trade?
There's a lot of people ask this because of just the size of the Chinese economy and the rivalry between the two. But I think if anything, this crisis really reaffirms how important the dollar is. Joe was telling about the foreign exchange market, $6.6 trillion a day turnover. 6.6 trillion. Global trade in a year is less than 30 trillion. So we see in the foreign exchange market in 1 week enough to cover world trade for a year. And out of those $6.6 trillion of trading, the dollar is on like one side of like 95% of the trades.
Wow.
Central banks use the dollar as a reserve currency, and you think about the supply chains we speak about, and a large part of them are funded with dollars, and the transactions, the trading, even if dollar is not the functional currency. So when China buys iron ore from Australia, they probably pay US dollars. When China buys oil from the Middle East, they're paying US dollars. So I think that in the world that we live in, despite the knocks that we might have in the US, that in the big picture of things, the dollar's role in the world economy is very secure. And I think a lot of
Okay,
countries are
good.
envious of what this allows us to do. But Joe might have some ideas too.
Yeah, and Joe, if we want to look back, how volatile has the Chinese currency been against the US dollar?
Interestingly, not very. The Chinese government, the People's Bank of China, it's what we call a managed peg.
Yep.
So they have a fixing rate. They publish a fixing rate on a daily basis, and the exchange rate in the market cannot deviate outside. I think it's a 2.3% band from that fixing rate on a daily basis. So the tariffs were a much bigger driver of exchange rate movement in that particular currency pair. So pre-tariff trade war, if we want to use that term, before that started, there were about 6.3 Chinese yuan to the dollar. Now there's about 7.1. So the Chinese currency did weaken as a result of the tariffs. But since the pandemic, you'd be very surprised how stable the currency has been. And it's really a result of the People's Bank of China managing that exchange rate. The only other thing I would add to what Mark said, and he touched on it, commodities are basically priced in US dollars, oil, gold, you name it. It's a dollar priced, those are dollar priced commodities. And so I think it would take a lot for the dollar to be replaced as a sort of the global reserve currency for a host of reasons, in addition to just that.
Okay, great, thanks. Marina, back to you. Do you think there was an article today in the Washington Post about just how behind the IRS is. They have, I think, 250,000 ITIN or individual taxpayer ID applications just sitting in a truck outside of their Austin, Texas facility, because they haven't been able to get in there. So the IRS is just incredibly behind. So two questions here. One is, do you think we'll see an increase in transfer pricing audits in the next year or so? And two, do you think the IRS will give us any guidance on how to deal with this new normal that we're in regarding transfer pricing?
I'm going to start with the second question. I don't think we will get any guidance. I think if we do it, it will be very minimal. It's similar to when the tariffs hit and everyone was expecting some kind of guidance. And the only small stirrings I heard, just because I happened to be on phone calls where, the commissioner was speaking or webinars or whatever, were something along the lines of normal course of business, nothing unusual. I mean, it's a political tariff, okay? It has nothing to do with transfer pricing. The taxpayer did not initiate it. It cannot recover. It cannot suddenly change its supply chain in order to, deal with transfer pricing considerations, right? So I think there's not going to be a lot of guidance because honestly, it's always the onus has always been on the taxpayer, right, to present their case and present their story, and it very much varies by industry, by company. I know, I'm calling all my clients, prospects, et cetera, now, and hey, what are your pain points? What's going on with your business, et cetera. And I always try to, guess what they're going to tell me before I get on the call. And I'm getting some surprises, some companies that I thought for sure, like their entire supply chain is in China. I thought for sure would be hit harder. They're not so much, for whatever reason, like their e-commerce has, suddenly just blown up, whereas before it really wasn't a factor of their business and other considerations. So it's really hard to tell, and there's no one formula. So the IRS, other than saying something like, try to propose an adjustment, propose an adjustment to us, there's really not much they can say that's specific. It's not a, it's not a formula. So.
Okay. Joe, we have 2 minutes left. And I think we've covered this, but we had a question come in and I wanted to get to you. What are the common misconceptions that CFOs have when transacting international payments? Any?
Yeah, I would say, one thing I mentioned this earlier. We talk to a lot of companies who only transact in U.S. dollars, and so they will say, it's too difficult, or I don't want to bill in local currency. That puts too much of a strain on our, I don't want to take that risk, so on and so forth. Again, I would say to that, you do have risk currently. I would call it an indirect currency risk. But if you do bill in local currency, you now have the power, the capacity to be able to hedge that risk for little to no cost, and probably not much of a time constraint on your business model. And yet then it takes the risk away from your client and could potentially increase top line revenues, since you're going that extra step by billing in local. That's one misconception that we kind of bump into here and there. Whoever asked that question, I would say if there are some misconceptions you have in mind that I could potentially dispel, I'd be more than happy to field those offline.
Great, thank you so much, Joe. Just to get a little bit, not little bit, but a completely different topic, since we have a lot of international businesses on the phone, I'm just going to say one thing, which is BE10, which is the Bureau of Economic Analysis. Every 5 years does a benchmark study on foreign investment or investment abroad, and just look it up because those reports are due at the end of the month. So I just want to let you know about that. Call me or look that up. Thank you all very much, Mark, Marina, and Joe, for participating today. Very insightful. I very much enjoyed it. And if you have any questions, our contact details are up there. Please feel free to reach out, and good luck getting into this new normal. Stay safe and stay healthy. Stay optimistic. Good night. Goodbye.